In February 2026, Canada approved just 24,900 new homes. That is the lowest number recorded in 3 full years. And most Canadians have absolutely no idea that number just dropped. Something is shifting inside the Canadian housing market right now, quietly, deliberately, and almost entirely out of public view. It is not a sudden crash making headlines. It is something slower and in many ways more dangerous. It is a structural change being engineered by policy decisions that will lock in the kind of housing available to Canadians not just next year, but all the way to 2030 and beyond. The people who understand what is actually happening right now are going to be in a completely different position than the people who find out too late. So if you have ever owned a home, dreamed of owning a home, invested in real estate, or simply want to understand what is being built in the country you live in, the next 10 minutes are going to matter to you. Fresh permit data landed for February 2026, and buried inside that report is a signal most analysts are glossing over. Not just a slowdown, a signal, a very specific, directional signal about what Canada's housing supply is going to look like by 2030. Here is why permit data matters more than any headline you will read this week. The homes being approved today are the homes that will exist or will not exist 3 to 5 years from now. When builders stop getting permits, they stop breaking ground. When they stop breaking ground, new supply disappears. And when supply disappears in a country with Canada's population growth and housing demand, prices do not gently correct downward. They climb. They climb until ownership becomes a privilege for a few, rather than a realistic goal for the many. That process is already underway. What we're going to do today is walk through the data point by point, connect it to 3 forces that most Canadians have never seen discussed together, and show you exactly what the landscape looks like from 2026 all the way to 2030. By the time we are finished, you will not just understand the headlines, you will understand what is actually driving them. 3 clues. Clue number 1. According to statistics, Canada's February 2026 report, the total value of building permits across the country dropped more than 8% in a single month, even after adjusting for inflation. 8%, 1 month. This is the weakest February Canada has seen in 3 consecutive years. And again, there is no pandemic to blame. No emergency, no crisis headline to explain it away. Builders are pulling back in a country that desperately needs more homes, and that should make every Canadian pay attention. Clue number 2 forces us to look beyond the headline number. The dollar value of residential permits did tick up slightly in February. At first glance, that looks encouraging, but when you break it down by housing type, the story completely changes. Almost every dollar of that increase came from multifamily projects, apartments, condos, and purpose-built rentals. Single-family detached homes, the product most Canadian families are still dreaming about and actively searching for in the resale market, actually declined. Only 24,900 total homes were approved in February, down from the month before and down from the same period last year. Builders are committing more dollars on paper while delivering fewer actual homes to the market, and almost none of the type that buyers most want. Clue number 3 is the one that confirms this is not a blip. Permits for offices, schools, and industrial buildings fell 24% in a single month. That collapse tells us the problem is not isolated to residential housing. It is a sector-wide confidence problem. The Canada Housing Corporation has already flagged this. They are projecting that new housing starts will continue declining through all of 2026 and well into 2028. The reasons are well documented. Construction costs remain stubbornly high. Financing is tight and expensive, and a growing inventory of unsold condos is sitting on the market, making developers extremely cautious about committing to new projects. 3 clues, 3 arrows, all pointing in the same direction. The question is, what is actually driving it all? The 3 hidden forces. Most housing conversations stop at the data. Today, we are not stopping there. Because underneath the permit numbers and construction trends, 3 distinct forces are operating at the same time. And when you see all 3 working together, the direction Canada is heading becomes unmistakably clear. The first force is federal housing policy. The Canadian government has committed billions of dollars to solving the housing crisis, and that commitment is real. But the destination of that money is something most Canadians are not fully aware of. It is not flowing toward detached family homes. It is going toward purpose-built rental units, modular construction, prefabricated housing built on public land, and high-density infill developments. The government's stated priority is speed and scale, getting the maximum number of units built as fast as possible. That goal makes sense on paper, but The type of home being prioritized in that strategy is a very specific one, and the traditional detached home is not it. The second force is Canada's climate commitment. Buildings and transportation together represent two of the country's largest sources of greenhouse gas emissions. Reducing those emissions is not a suggestion, it is legally bound into Canada's National Climate Framework. And that legal commitment shapes housing policy in ways that rarely make the front page. When your emission reduction targets require smaller buildings, less car dependency, and more walkable communities, the policy environment naturally shifts away from large footprint homes on large lots in car-dependent suburbs. It does not happen through an outright ban. It happens through incentive structures, zoning changes, and funding priorities that quietly favor one type of housing over another. The third force is the one that ties everything together, and it is the concept most Canadians have never heard discussed in the context of their own neighborhood. It is called the 15-minute city. The premise is straightforward: design communities so that a resident can reach everything they need, their workplace, school, grocery store, doctor, and park, within a 15-minute walk or bike ride. No car required. The idea has genuine appeal. Put all three forces side by side: a federal government funding compact rental housing, climate framework discouraging large footprint living, and an urban planning philosophy demanding density. And you are no longer looking at separate trends. You are looking at three pillars of a single consistent direction. A direction that is, deliberately or not, steering Canada away from the detached family home as its default model of housing. This is already happening. Through 2026 and into 2027, single-family construction continues declining. The inventory of available detached homes in desirable areas grows thinner with every passing quarter. Competition for what remains intensifies. Prices in the detached segment hold firm or rise even as other parts of the market soften. Buyers who are waiting for a correction in this specific segment may find that the correction never comes because the product itself is simply disappearing from new supply. By 2028, the ownership divide becomes harder to ignore. A growing share of Canadians will be renting long-term, not because they prefer it, but because the path to ownership has effectively closed for their income level. Consider the scale of the gap. Canada needs between 430,000 and 480,000 new homes built every single year through 2030 just to bring affordability back to reasonable levels. Canada is currently building barely half that number. That gap does not close quietly. It closes by pricing people out. By 2030, single-family homes will likely represent a small fraction of new construction. They will still exist, but increasingly as premium products in premium locations, further from city centers, further from jobs, and significantly more expensive in real terms than they are today. For a large and growing share of Canadians, denser housing will not be a lifestyle choice. It will be the only financially viable option on the table. That is not a prediction designed to alarm. It is the straightforward arithmetic of current supply, current demand, and current policy direction. What this means for you. If you are an investor, the rental demand story through 2030 is powerful and data supported, but location discipline is going to matter more than at any point in the past decade. Properties within reach of transit, employment, and daily services will outperform significantly. The era of buying anywhere and waiting for appreciation is narrowing. Precision matters now more than it ever has. And if you are a parent trying to help your children access the market, start that conversation now. Not next year, now. The window of affordable entry into homeownership is not holding steady. It is actively shrinking. Every year without a plan is a year of options lost. Closing. The decisions shaping Canadian housing right now are not being made at the kitchen table. They are being made in policy documents, zoning hearings, and federal budget line items. And they are not going to pause while Canadians catch up to what they mean. The data is not ambiguous. Direction is not hidden. The three forces, policy, climate, and urban planning philosophy, are already in motion and already reshaping neighborhoods across this country. What happens next depends entirely on how many Canadians understand what is coming and make deliberate choices because of it, rather than in spite of it. The shift is already underway. The only question left is which side of it you're going to be on. So tell us in the comments, are you happy with the direction Canadian housing is heading? And what does everything we covered today mean for your next move? If this gave you clarity, share it with someone who needs to hear it. Thanks for watching. We will see you in the next one.